Well, the latest Westpac Melbourne Institute Consumer Sentiment Survey has just been released for the month of February, and perhaps no surprise given the survey was in the field during the week of the RBA hike. It's detected a further shift towards pessimism. The sentiment index dropped 2.6% this month to 90.5. That's actually a little bit milder than the reactions we've seen to previous RBA rate hikes. Yeah, on average, sentiment's fallen by about 4 percentage points in a month where the RBA's moved. Of course, context is important here. The RBA's February move was widely anticipated, and sentiment had already weakened in the previous couple of months as a lift in inflation had raised concerns that interest rates were about to rise. The detail, though, does suggest that this was a little bit milder than could have been expected. Responses over the course of the survey week actually improved slightly, about 0.6% amongst those surveyed after the RBA decision. And interestingly, the mortgage belt, sentiment-wise, was largely unchanged in the month. There's a bit more in the detail here as well. Component-wise, the main movers this month were a deterioration in assessments of family finances compared to a year ago, and assessments of whether now was a good time to buy a major household item. Those two particular components were down 4 to 6% compared to a month ago. Again, sort of highlighting the direct impacts not only of the interest rate rise, but also of higher inflation. We've seen particularly strong inflation reads in some states like Queensland that look to be having a direct impact on the cost of living affecting family finances. Where there was resilience was around the year ahead view. Expectations for both finances and the wider economy holding their ground this month, and that speaks to some improving underlying momentum to the consumer. That's something we highlighted in our latest Westpac Red Book report, which went out last week, which is indicating that the momentum of the consumer sector coming into 2026 is actually not too bad. And that starting point looks to be providing some support for those year ahead expectations. There was some softening in medium-term expectations for the economy, though. That sub-index down 2.5% in the month, and that sort of speaks to one of the key messages from the RBA decision, which was that they expected this to be a long inflation fight, that inflation was only expected to return to its 2 to 3% target range next year, and not to be at the midpoint of that range even by the middle of 2028. So consumers are definitely bracing for a significant protracted inflation fight. It doesn't seem to, the sentiment read is sort of consistent with a further weakening. It's not saying that consumers are panicking. They're not seeing the RBA back on the inflation warpath like they were back in 2022-23, but they are bracing for a significant further tightening. When we ask consumers specifically about their expectations for mortgage interest rates, 80% expect rates to be higher over the next 12 months, and a third expect that increase to be 1 percentage point or more. So clearly bracing for further rises. Interestingly, there's a lot of interesting stuff in the detail here by subgroup and some of the other detail. Housing is one area that is particularly notable. The shifting inflation interest rate landscape has put a wedge between housing expectations. On the one hand, assessments of time to buy have weakened materially. That time to buy dwelling index has dropped back to 84. That's 35 points below the long run average, a very deeply pessimistic level. But around prices, expectations have lifted to a 15-year high with some very bullish expectations, particularly in Western Australia and Queensland. So there's a definite wedge, a big wedge emerging around housing market expectations, pointing to a real tension in the market over 2026. But stepping back from this, the latest index read of 90.5 is firmly pessimistic. Clearly, the RBA's decision has realised fears of the previous few months. We're back firmly in pessimistic territory. That may stabilise a little in the next few months, but with the RBA likely to continue signalling a likely further increase in rates, and we think they will deliver a further increase in May, it looks like we'll see some further softening in sentiment over the first half of this year. Fortunately, it looks like the consumer and sentiment and the consumer more generally, perhaps the economy, is once again hostage to inflation and interest rate circumstances in 2026.